Right now, something serious just happened in the silver market. And if you blinked, you probably missed how violent it was. Silver dropped 37% in 48 hours. Let that sink in. Roughly $1.4 trillion in market value didn't slowly leak out. It vanished fast. And here's why this matters today, not 6 months from now. JPMorgan just warned that silver could fall back toward $50 an ounce, which would be about a 50% hit from the recent $120 highs. Stay with me because I'm going to show you why this wasn't random, why it's not over, and how you can spot this setup before it traps you next time. Before I explain what caused this, let me teach you something most people never really internalize about markets. Price doesn't move on belief, it moves on positioning. You can love silver, hate silver, or think it's going to save the world. None of that matters if the market is leaning too far one way. Think of price like a crowded elevator. It doesn't break because people are wrong about where it's going. It breaks because too many people piled in on one side. And when the door opens, everyone tries to exit at once. That's what leverage does. It packs the elevator beyond what the cables can safely hold. Now, when I say positioning, I mean who owns what and how they own it. Are they using cash? Are they using borrowed money? Are they in for the long haul? Or are they momentum traders who'll flip positions the second things change? This is the difference between capital and speculation. Capital sits, speculation moves, and speculation amplifies everything, both the rallies and the crashes. Most people don't understand that silver's 200 to 60% year-over-year rally didn't happen because of slow, steady capital. It happened because speculative money piled in. Momentum funds, leveraged futures, traders who weren't buying silver. They were renting it with borrowed money. And borrowing works beautifully on the way up, until it doesn't. Here's what you need to know about leveraged markets. They don't correct politely, they snap. So what does that tell us? It tells us that when you see parabolic price action, when you see assets doubling or tripling in a year, you're not looking at steady accumulation. You're looking at leverage building. You're looking at a structure that's inherently unstable. Not because the underlying asset is bad, but because the way people are holding it makes it fragile. If this is making sense, drop a comment below and let me know if you've seen this pattern play out in other markets, because once you recognize it, you'll see it everywhere. Now, here's what's actually happening under the hood. Let me break down the sequence. Silver goes parabolic, up 200+% in a year. That kind of move attracts the fastest money in the system. Futures traders crank leverage. They're not putting up $100,000 to control $100,000 of silver. They're putting up $10,000 to control $100,000. That's 10 to 1 leverage. Some are going higher, and when price keeps rising, that leverage looks genius. Your 10,000 controls an asset that just went up 20%. You didn't make $2,000, you made 20,000. You feel unstoppable. But then exchanges notice volatility rising and quietly tighten margin requirements. That's the first pressure point. What used to require 10,000 in margin now requires 15,000. If you're fully deployed, you don't have an extra 5,000 sitting around. You either add cash or you reduce positions. And here's the thing. Most leveraged traders are already all in. They don't have extra cash, so reducing position size is the only option. Then price stalls, just stalls. That's all it takes. When price stops going up, leveraged traders don't have time. They're paying interest on borrowed money. Every day that silver sits flat, they're bleeding. But more importantly, they're sitting on unrealized gains that could evaporate, so they start taking profits. Not because fundamentals changed, because liquidity did. Because the cost of staying in just went up. Here's where it gets mechanical. When the first wave of profit taking hits the market, price dips. Maybe 5%. That dip triggers the next tier of margin calls for traders who were already at their limit. Remember, they borrowed money to be here. A 5% price drop on 10 to 1 leverage means they just lost 50% of their capital. Their broker doesn't wait. The broker issues a margin call. Add more money, or we liquidate your position. Most can't add money. So, liquidation begins. So when forced selling starts, here's the cascade. Selling pushes price down. Lower price triggers more margin calls. More margin calls create more selling. That selling hits thin order books because everyone on that side is already in. There's no one left to buy. The bid side of the order book is empty. So price has to fall further to find the next buyer. And that next buyer isn't sitting at $115. They're sitting at 110, then 105, then 100. That's how you get a 37% collapse in 48 hours. And here's what's wild about this. The selling doesn't wait for consensus. It front runs fear. The first sellers get out at 115. The last sellers are fighting to get out at 75. That's a $40 difference in execution. Same intent, wildly different outcome. Speed matters in a deleveraging event. But here's the part that should make you nervous if you're not watching closely. Volatility expanding while physical premiums stay elevated is a sign the unwind isn't done yet. See, when you have a healthy correction, both futures and physical markets move together. Price drops, premiums compress, volatility cools, everything resets. But when futures are collapsing and physical premiums are still high, that tells you the paper market is unwinding, but physical demand hasn't budged. That divergence creates tension, and that tension usually resolves with more downside until the two converge. Now let me show you what very few people are talking about. This wasn't a shock to the system. This was the system working exactly as designed. Futures markets exist to provide price discovery and liquidity, but they also exist to absorb speculation. And when speculation gets too thick, the market has a built-in mechanism to flush it out. It's called a margin spiral, and it's happened before, many times. The mechanics I just described aren't unique to silver in 2026. They're a feature of every leveraged commodity market. Oil, copper, natural gas, gold, wheat. When leverage builds and volatility rises, exchanges adjust margin requirements. When price stalls, forced selling begins. When forced selling cascades, you get violent moves. This is the exact same playbook silver has run before. Every time leverage and momentum dominate, the mid-cycle drawdown is brutal. Look back at the 1970s silver bull. The Hunt brothers started accumulating silver in 1973. By 1974, silver had rallied from under $2 to over $6. Massive rally. Then what happened? The market corrected nearly 50% back toward 350 before resuming the next leg higher in 1978. That next leg took silver all the way to $50 by 1980. But the mid-cycle correction? Brutal. It shook out everyone who bought near $6 thinking it was going straight up forever. Or look at 2011. Silver rockets from $18 in late 2010 toward $50 by April 2011. Sentiment goes euphoric. Everyone's talking about silver going to 100. CNBC is running special segments. Retail investors are piling in. And then what happens? Silver gets cut in half within weeks, falls back to $32, then keeps falling to 26. Late buyers get punished. They bought at 48 thinking they were early. They weren't. They were the exit liquidity for the smart money that had been accumulating at 15 and 20. Early buyers survive. The people who bought silver at $12 in 2009, who rode it to 50 and took some profits on the way up, they were fine. They had cushion. But the person who bought at $47, they held for years underwater. Some never recovered. Same asset, different entry points, wildly different outcomes. When you zoom out, you see the larger story. Silver doesn't die in these moments, it resets. But resets are violent. They have to be. Because the only way to clear out leverage is to make holding painful. You can't politely ask speculators to leave, the market forces them out, and it does that through price pain. Fast, brutal, unforgiving price pain. Every time this happens, the narrative is the same. First, it's denial. This is just a healthy pullback. Then it's anger. The banks are manipulating us. Then it's capitulation. I can't take this anymore. I'm out. And that final capitulation, that's usually the bottom. Because that's when the last leveraged player exits. That's when the selling exhausts itself. And that's when patient capital starts quietly accumulating again. Now, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this be manipulation? Could big banks be pushing price around? Let me be honest. Markets can be influenced, but they can't override leverage math forever. If silver was at $120 purely because of manipulation and there was no underlying leverage or speculation, this kind of collapse doesn't happen. Manipulators can't force thousands of independent traders to get margin called simultaneously. They can't force exchanges to raise margin requirements. They can't force futures contracts to settle. Could central banks be involved? Could this be about suppressing precious metals to protect fiat currency credibility? Maybe. I'm not going to sit here and tell you that's impossible. But here's the thing. It doesn't actually matter whether there's a conspiracy or not. The mechanics are what matter. Forced selling doesn't care about narratives. It doesn't care about conspiracies. It cares about margin. If you're leveraged and price drops, you get called. Period. Your broker doesn't ask if you think the banks are suppressing silver. Your broker asks if you can meet the margin requirement by tomorrow morning. So instead of arguing about motives, focus on what you can control. Watch positioning, watch volatility, watch liquidity. That's where the truth shows up. You can see leverage building in open interest data. You can see volatility expanding in options pricing. You can see liquidity thinning in bid-ask spreads. Those are objective measures. They don't lie, and they give you advance warning when a market is getting fragile. Could this just be profit taking after a huge rally? Absolutely, that's part of it. But profit taking alone doesn't give you 37% in 2 days. Profit taking is orderly. This was disorderly. This was forced liquidation. So, yes, some of it is natural profit taking, but the violence tells you leverage was involved, always. There are probably 3 types of people watching this right now. Some of you rode silver up and you're sitting on profits wondering if you should bail. I get it. You bought it $70 or $80. You watched it run to 120. You've got a $40 to $50 gain per ounce. That's real money. And now you're watching it collapse back toward 90, and you're thinking, should I lock in what's left before it gets worse? Here's what I'd say. Your job isn't to catch the top, it's to protect capital. If volatility keeps expanding, if we keep seeing these violent swings, patience pays. Don't panic sell at the bottom of a flush, but also don't stubbornly hold if the structure is broken. Watch the stabilization zones. If price can hold 95 to 100 and build a base, you're probably fine. If it breaks through 80 with conviction, that's a different story. Others bought late near the highs, and this move feels personal. You bought at 110 or 115. You thought you were getting in on the breakout, and now you're down 20, 25, maybe 30%. It hurts. I know it does. But here's the truth. The market didn't target you, it followed mechanics. You weren't wrong to see value in silver. You were early or you were late, depending on how you frame it. But either way, you're in now. So the question isn't, should I have bought? The question is, what do I do from here? For you, survival matters more than being right. If you're not leveraged, if you own physical or shares outright, you can afford to wait. Time is on your side if the fundamentals are intact. But if you're leveraged, if you're paying interest or facing margin calls, you need to reduce risk. Cut position size, take the loss, live to trade another day. And then there are long-term believers who don't trade at all. You see this as noise. You're stacking physical. You don't care what the spot price does this week or next. You're holding for 10 years. That's fine. I respect that mentality. Just recognize that even long-term trends have air pockets, and timing still affects outcomes. If you're dollar cost averaging, you're probably fine. If you deployed everything at 115, even as a long-term holder, you're going to feel that pain for a while. So here's what I want you to answer in the comments. Which type are you? Are you sitting on profits trying to decide your next move? Are you underwater trying to survive? Or are you long-term and unbothered? Let me know, because your situation determines your strategy. Here's where I stand. I'm not panicking and I'm not buying blindly. I'm cautious and observant. Let me tell you what I'm personally watching. First, I'm watching the $95 to $100 zone for stabilization, because that's where forced selling should start exhausting itself. If silver can hold above 95 for a few days, build some support, see volume dry up on the downside, that would indicate the liquidation phase is ending. We'd start seeing buyers step in. We'd see volatility compress instead of expand. Second, I'm watching the 70 to 80 range as a deeper deleveraging zone if volatility doesn't cool. If we break 95 with heavy volume, if the selling accelerates instead of slowing, then the next logical support is back toward the prior breakout levels from earlier in the cycle. That's where you'd expect long-term holders to defend. That's where the real accumulation started before this parabolic run. If we get there, it's going to test a lot of people's conviction. Third, I'm monitoring whether physical premiums and implied volatility compress instead of expand. Right now, premiums are still elevated. Implied volatility is still high. That tells me the market is still unsettled. If those metrics start normalizing, if premiums come back toward historical averages and implied vol drops back under 30, that would signal we're moving from panic to stabilization. Based on my analysis, this move was mechanical, not emotional. It was driven by leverage unwinding, not by a fundamental shift in silver's long-term story. The factors that drove silver higher, whether that's monetary policy concerns, industrial demand, supply constraints, those haven't disappeared. But the speculative froth needed to clear, and it's clearing now. The question is how much further it needs to go. The long-term story isn't dead, but it's early. If history rhymes and silver consolidates here, the move that follows could be substantial. But consolidation takes time. Bases don't form in a week. They form over months. So if you're expecting silver to bounce back to 120 next month, you're probably going to be disappointed. If you're thinking about where silver might be in a year or two, assuming the fundamentals hold, that's a different conversation. Let me be clear. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the data yourself. Look at the charts. Read the JPMorgan report. Understand the mechanics. Don't take my word for it. Don't take anyone's word for it. Your capital is your responsibility. If you made it this far, you're the type of person who thinks critically about markets instead of just reacting emotionally. That mentality will serve you well. Most people panic when they should be patient and chase when they should be cautious. You're here because you want to understand the game, not just play it blindly. That puts you ahead of 90% of market participants. If this breakdown helped you see the pattern, do me a favor. Share this with someone who needs to hear it. Leave a comment with your biggest takeaway. And if you haven't already, subscribe because I'm going to keep breaking down these moves as they happen. The market doesn't wait for you to catch up. You've got to stay ahead of it. Think critically, verify the data, and make decisions that keep you in the game. Stay sharp out there.